Good afternoon. Welcome, everyone, to Homestead Funds, Homestead Advisers webinar series, Investment Insights and Business Strategies. Today, our webinar topic is Resilience in the Face of Natural Disasters, Strategies for Cooperative Financial Preparedness. This is a topic that we covered way back in 2019, 2020. And we thought it'd be a good time to provide some updates on what's been going on, both at the federal level and also what's going on within Homestead Advisors. But before that, we're going to do our typical market update. So the meeting format, as always, after our capital markets review, we'll introduce our guest speaker and jump into our webinar topic. All attendees are on mute, so if you do have questions, and we hope you do, please submit them using the Q&A feature. And as you know, this meeting is being recorded, and you'll get the recording via an email next week. So those of you that need CEU credits, your proof of attendance will be provided in the post-event email. So we don't need to see who I am. You can see me on the camera, but I'm Mark Santero, President and CEO of Homestead Advisors. Today, with me to do the market update, I brought along Mauricio Agadello, who's our head of fixed income, and Jim Polk, who is our head of equity investments, to give you their insight into what's going on in the markets. So without further ado, let's start the market review and outlook.
Thank you, Mark, and thank you, everybody, for joining us. I'll give a quick recap of the equity markets in the first quarter, and then Mauricio will do the same for the fixed income market. It was interesting. Generally, the market was positive on the equity side. The S&P was up about 7%. There was obviously a lot of angst at the end of the quarter with the run on the banks, particularly Silicon Valley and Signature Bank and First Republic, which ultimately got bought by JP Morgan. And we'll get back to that in a second. But the Fed did a terrific job of containing it, providing liquidity, and that angst seemed to dissipate as the quarter went on and as we went into the second quarter. There's clearly a lot of talk and concern about the Fed's rate hikes and the impact that they're having to the economy. We are certainly seeing that impact to some extent. We can talk about that a little bit later, but it's certainly the significant rate hikes are having an effect in slowing the economy. The consensus has been that we're going into a recession. That has been the consensus for a while. And we are certainly seeing data that suggests that things are slowing down and that the Fed's having its intended impact by raising rates. But you're still seeing some offsets to that. The employment levels remain high. Cash on consumer balance sheets, although lower, is still relatively high. But importantly, employment rate remains relatively robust. But you are seeing some signs that things are slowing down. Consensus estimates for the year are starting to come down. They were around 231 at the start of the year. They're around 214 now. So certainly there has been some impact in the economy. But in general, the equity markets have been well behaved in the face of this data. With that, I'll turn it over to Mauricio.
Thank you, Jim. From the fixed income side, the first quarter delivered positive returns. The flagship benchmark, the U.S. aggregate bond index, returned just under 3%. So we certainly welcome that after the overall negative returns for the market in 2022. The positive returns were driven by mainly at the back end. That will be the 10-year and 30-year maturity yields declining in that part of the curve. Yields went down. And additionally, we are earning a higher coupon in fixed income, which we certainly welcome. I would love to see that. The Fed did increase rates by another 25 basis points in March. Again, we're almost at the end of May, and they have already increased by 25 more at the May meeting. We will go more into Fed policy in this presentation and what it means going forward. But from a recap standpoint, that's where things stand at the end of the period. Next slide, please. What's driving Fed policy? Inflation continues to be the main driver of monetary policy decisions. Although inflation is down from the peak that we saw in June of 2022, slightly above 9%, if I recall, 9.1%. it has been coming down with the latest CPI reading inside of 5%. That being said, I think this is the bigger part of the challenge for the Fed, bringing inflation down to the long run of 2%. So they are quite aware of this, signaling that Fed policy should hold higher for longer. If we go to the next slide, we do see signs that inflationary pressures continue to ease, particularly when you look at the rate of growth for money supply, that has been in a steady decline. Also, from a goods inflation, that has given some extra relief to the U.S. consumer. Now, if we go to the next slide, this is the challenge that a lot of our stakeholders and co-ops face: labor. The employment picture remains very robust. Unemployment levels are currently sitting at near all-time lows. Wage increases have been declining, but they are still at levels prior to the pandemic. The upward pressure in wages is making the Fed's job difficult, with the service sector being very sticky. The Fed anticipates that at some point, the unemployment rate will increase, and that will contribute to lower inflation in the long run. We, on the fixed income team, we monitor the weekly jobless claims, more looking at an average, and we have seen a steady increase in filings for jobless claims, which tend to be a leading indicator for the overall employment picture and the economy. Now, if we go to the next slide, this is the big question. Are we heading into a recession? On our side, we view the yield curve inversion as a very strong signal. Additionally, when you combine that with the leading economic index, is definitely flashing warning signs for us. The employment picture, as I mentioned, remains very strong. We do think that this could change in the next 6 to 12 months. We anticipate certainly a level of a softening in economic activity. And now let me hand it back to Jim to get some perspective from the equity team.
As I said earlier, are we going to go into recession? Certainly the data would suggest that that's a possibility. You've had multiple years of a very accommodative Fed that's now trying to put the brakes on an economy and really try to thread the needle, if you will. That's consensus. What I would say, if you look at the market is reflecting that in a funny sort of way. Like the top 7 names have really driven a lot of the outperformance in the S&P. And when you back those out, the S&P 500 is really trading at a reasonable multiple in the mid-teens. Next slide, please. We've shown this slide before, but as head of the equity group, I can't say this enough. If you have a long time horizon, I'm not talking about like next week or next month, but the equity market has historically rewarded patient investors. And so if you have capital that you're putting away for something longer term, the equity market is the place to be. Next slide, please. I want to just touch on the banking sector. I mentioned it earlier. I won't read all these bullet points, but the gist of it is that you had a run on the banks, and the Fed stepped up and they provided liquidity, and they did a great job of really squashing that, if you will. And so you've had that phase of it. And the phase that we're in now is more of a typical economic cycle phase where the Fed's raising rates, deposit rates are going to have to go up, net interest margins are going to have to come down, and you go through a more typical cycle. When we looked at the most recent senior loan officer survey that the Fed publishes on a quarterly basis, what you see is just that. Banks are slowing their lending. They're tightening their lending standards on the commercial and industrial loans, on the commercial real estate, and on the consumer loans. So the run on the banks and the issue that we had in the first quarter might actually be helping the Fed. We think this might be happening at an accelerated rate more than it would be based on some of the economic data. So again, first part was kind of a run. And then the second part is really just more typical what you would expect at this point in the cycle. Next slide, please. So I'll just take the first couple of bullet points. We think that there's still a lot of choppiness ahead. You've got lots of uncertainty about what that real inflation number is, what the real economy looks like, how aggressive the Fed will act. I know Mauricio is going to touch on that in a second. Obviously, today is May 23rd. We're just a week away or so from the June 1st deadline of the debt ceiling. There's obviously a lot of negotiations going on that's creating some angst in the markets currently. And so that's still playing out. The second point is, as I said before, it's consensus that we're going to be going into a recession. I guess the less consensus piece of that is whether it will be mild or severe and how much the Fed will impact that. They've got a difficult task ahead of them. So there's a lot of uncertainty about that. We on the equity team aren't completely convinced that we're going into a recession, but certainly based on some of the things that we just talked about, you can't rule that out. And then really the third point is that since 08, 09, of this very accommodative monetary policy, you've even had zombie companies, these unprofitable companies being propped up as people moved out of the fixed income market and they went further out on the risk curve. That's coming home to roost, and that's kind of changing as interest rates rise and they normalize. We think at Homestead, where we're buying higher quality companies and looking longer term, again, that goes back to the long-term equity chart. That's actually really a good place to be over time. With that, I'll turn it over to Mauricio.
Thank you, Jim. On the fixed income side, as I mentioned before, coupon and income, we're back. The income is back in fixed income, and we certainly welcome that. The fact that investors can now earn a higher return in lower risk assets, it's a good thing. Since the financial crisis in 08, 09, there's been a great chase for yield, and we haven't seen this type of yields in over a decade. We see it all over us with deposits going into money market funds that are giving us a good level of income. And we do think that this should continue as the Fed has to maneuver a challenging environment to bring inflation down. Now, that being said, talking about the Fed, since the last Fed meeting, we've had a few Fed speakers come in to provide an outlook for more rate hikes. And some are calling for another rate hike in June, some are not. I'm in the camp that the Fed should take a pause. It takes an average 12 to 18 months for Fed policy to trickle down into the economy. And we are starting to see the effects of that. We are seeing tighter lending standards, the auto industry, auto loans slowing down. We are seeing the mortgage market with 7% type mortgages. So it will take time. And I think the dispersion of the market pricing in rate cuts in the second half of this year and the Fed telling us that they will be higher for longer, that will create some level of volatility, and volatility creates opportunity for us being active managers. And with that, let me hand it back to Mark.
Thank you, Jim. Thank you, Mauricio. So I'm going to touch real quick before we start our topic. Next slide, please. Some of the issues that co-ops face given the economic uncertainties that we're facing. Throughout my travels and the team's travels, we hear from you about some of the challenges that you face. Right now, it goes without saying, market uncertainty and volatility is something that we're all facing in managing our businesses. We're here as a service. If there's anything we can do with either your CFOs, your HR managers, certainly your CEOs and general managers, we're here to help you with periodic reviews of your investment accounts or your situations. More importantly, though, are some of the issues that we see around labor. Workplace challenges in hiring, retaining, and attracting talent persist now more than ever. We just heard from Mauricio about the labor issues affecting inflation. Well, there are plans that we sponsor with NRECA to help your cooperative. Deferred compensation, employee-sponsored savings plan. We have a new program, cash retention programs that are for non-highly compensated people. It's not on here, but something that we'll be able to talk to you about. We're going to do our next webinar on labor concerns, so more to come on that. But it's the environmental uncertainties, which is the natural disasters that many parts of the country face today and continue to face, that we're going to touch on today. So these are the issues that we hear from you, and we try to use these webinars as a means to address them. So if we go to the next slide, just to reiterate, be prepared. Money decisions affect your membership Caring for communities helps your standing in your communities and funding various programs through unclaimed capital credits, attracting and retaining employees, as I mentioned just in the previous slide, now so much more important than ever. And then engaging and educating employees, using Homestead Advisors as a valuable resource to help your employees be financially prepared for their life's uncertainties, and financial wellness as a part of the services that you can offer through Homestead Advisors at no cost. So let's talk about, next slide, please, the programs that we have for co-ops. I touched on these. We're going to talk about storm reserve accounts, the one up there in the right-hand corner, making a plan to help grow your assets into capital that you can use for emergencies and future spending needs. So with me today, if we go to the next slide, is Martha Duggan, who is within our GR group, Regulatory Affairs. Martha is a Senior Director of Regulatory Affairs for the National Rural Electric Cooperative Association. I think many of you know Martha as our resident expert on everything FEMA specifically, and she's worked with us in the past and giving us updates on what's going on at the federal level and the importance of dealing with FEMA and how a group like Homestead could help offset some of those challenges. So without further ado, Martha, I would love to welcome you and hand the microphone over to you to touch on the next few slides and give us a FEMA update.
Thank you so much for that kind introduction. I'm really delighted to be back with you, Mark, for another webinar about FEMA. We did this a couple of years ago, and we wanted to do it again just so we could talk about FEMA, some of the things that are changing in FEMA, but notably some of the trends that we're seeing in natural disasters. And we pretty much all know, because we're living through it, that natural disasters are becoming more frequent and more intense. We talked about this on the webinar a couple of years ago, and really things have only gotten more intense and more frequent since that time. And more types of disasters like wildfires and ice storms are rising to the federally declared and therefore FEMA supported level. So many electric cooperatives are experiencing working with FEMA for the first time, and many are unfortunately well accustomed to going through the FEMA process. So a couple of statistics about the increasing intensity and frequency. So 43% of the billion-dollar natural disasters that we've experienced as a nation have occurred in the last decade. So that is an incredibly increased level of these very high-dollar disasters. FEMA is still an important source of reimbursement for disaster expenses for electric cooperatives. Now, traditionally, electric cooperatives are eligible once a disaster is declared by the president for reimbursement of up to 75% of the expenses that it incurs during the disaster. So the co-op is responsible for the other 25% of those disaster expenses, or frankly, what the federal government doesn't pay or disallows. Those who have lived through the FEMA experience know that FEMA is very exacting and specific and sometimes less than reasonable about approving what we declare as natural disaster expenses. So there's very rarely, if ever, 100% coverage from FEMA for these natural disaster expenses. One trend that I wanted to talk about, Mark, is that in view of these increasing numbers and intensity of disasters, FEMA has shifted its focus to putting a lot of emphasis on mitigation programs. And those programs are designed to strengthen and harden infrastructure of all sorts against future damages. So FEMA's thought is, let's harden and strengthen things before they get destroyed by a disaster. So I want to talk about some of those mitigation programs just for a few minutes. But I also wanted to tag back to something that you and the team have been talking about, and that is the labor issue in our economy. I was just at FEMA the other day and was told that FEMA is short by 6,000 employees of a full head count. So not only do we have increasing numbers of disasters, increasingly terrifying disasters, we also have FEMA that's understaffed and overworked. And so the amount of time it can take between experiencing the disaster and getting reimbursed from FEMA is growing. And that will probably be a trend that we will continue to see. But let's talk about mitigation for a moment. If we could go to the next slide. So one of the programs that I wanted to highlight is called the BRIC program, or Building Resilient Infrastructure and Communities. Now, this is a non-disaster grant program that actually reimburses folks for any kind of spending that is designed to harden or mitigate any future disaster issues with it. And you can see on the slide the size of this fund. In fiscal 21, it was just over $1 billion. In fiscal 22, it was over $2 billion. And the reason it's growing every year, and we expect that it will continue to grow, is that the funding for BRIC is a formula that's based on the amount of disaster spending that FEMA does in the prior year. So as FEMA spends more, the BRIC funds will continue to grow. So there are all kinds of potential opportunities with the BRIC program for electric cooperatives. At the moment, the only eligible applicants are states, tribes, and territories that have had major declarations in the past 7 years. Unfortunately, that includes pretty much every state in the United States and many of the U.S. territories. But the point here is that an electric cooperative has to work through the state to become eligible for any BRIC funding. So if we could go to the next slide, I show here some of the possible co-op BRIC projects that folks could be thinking about. And they're things like undergrounding. They're things like hardening against wildfires, which, as we know, are becoming an increasing issue, not only in the West, but also in Texas and Kansas, all over the United States. It can be used for projects that have to do with flood proofing, elevating structures, any of a number of kinds of projects that are probably on the capital project plans of many electric cooperatives. Now, the projects that you want to use BRIC funding for have to be part of your FEMA-approved state hazard mitigation plan. And that process, getting your project recognized, involves working with your state hazard mitigation officer. It's a terrible acronym, SHMO. They're known as SHMOs, if you can believe that. And that is the person who will get your project into the state-approved plan. Another thing to know about BRIC is that it does require a federal cost share. So like the disaster programming, under which we get approximately 75% reimbursed, a BRIC project does require an electric cooperative or other participant to use some of their own capital to become involved in this program. I raise that, Mark, because it occurs to me that having funds ready for the unfederal cost share, funds that could be eligible from the storm reserve accounts that you all have created, could be an immense advantage to electric cooperatives as they consider participating in the BRIC program. I will just conclude my prepared remarks by saying that FEMA does remain an important source of disaster recovery funds for electric cooperatives. But the process is not smooth, the process is not easy, and it's never 100% reimbursable of expenses that co-ops experience during natural disasters. So with that, I will ask you to go to the last slide, which has my contact information, and I'm happy to talk to anyone about FEMA and other issues.
Thank you, Martha. One quick question. I know we have a question and answer session at the end, but I never miss an opportunity to ask the expert here. Can you give a ballpark figure? God forbid a disaster hits, and Lord knows we've seen way too many the past few years. It's been our last webinar with you. It just seems like it's just keeps on getting worse and worse. what is the typical time period between when the president declares an area, disaster area, and the application for funding and whatnot and getting that reimbursement? Is it months? Is it years? What can a co-op expect if they had to go down that route, unfortunately?
Yeah, let me give you a couple of bookends, Mark. So once the disaster is declared at the federal level and FEMA lands on the scene, there's a very tight time frame to identify damages and to create what's called a project worksheet, which goes to FEMA and starts their analysis of was the facility eligible, was the cost reasonable, et cetera, et cetera. Unfortunately, that's when the really long delays can happen. And I can tell you that there are co-ops in Louisiana, for example, who are still waiting on funds related to Hurricane Katrina. So it can be a years-long wait, and it is very much dependent on the size of the disaster, the scope of the disaster. And again, I go back to that 6,000 employee shortage that FEMA is experiencing. It just takes a long time.
Thank you. I didn't mean to depress any of our participants, but I think being prepared for the unexpected is our job. I thank you, Martha. If you can just hang around for the next few minutes in case any more questions come up. If we can go to the next slide. Being prepared for these types of events is all in our membership's best interest. And when we talk about a storm reserve account, very much like how Homestead Advisers was created back in 1990 by co-ops for co-ops, the storm reserve program was created by a co-op with us for that co-op because of hurricanes that were hitting them down in the northern neck of Virginia. So one of our co-ops in our backyard. And as we talked about, unfortunately, it's happened all over the country, not just the Southeast. So Brian Allen is our manager of institutional sales. You all know him. Brian was intimately involved with this co-op in creating the storm reserve program accounts. And I'm going to ask Brian real quick to go over how easy it is and how important it is to be prepared and how simple it is to get this program initiated because of the uncertainties of FEMA, the uncertainties of those funds being available, if in fact they are, and certainly if you have insurance deductibles. But the most important thing is getting your crews ready, getting your supplies ordered to meet the needs of your membership until those funds arrive. So Brian, why don't you take it away?
Thank you, Mark. Appreciate the introduction. As the manager of institutional sales, I serve as a relationship manager that works with cooperative leadership like you to really understand cooperative workplace challenges and how Homestead Funds can provide solutions to those challenges using our products and services. So over the past couple of years, I've had many conversations with cooperative leadership about organizational workforce challenges. And it's been during those conversations that I've discovered that very few cooperatives are actually prepared for unexpected emergencies that affect them on the organizational level. So in 2019, a cooperative in the East Coast, as Mark pointed out, took the concept of preparing for unexpected emergencies and created the very first storm reserve account with Homestead Funds. So in my part of the webinar today, we're going to explore how your cooperative can financially prepare in the event that a devastating storm comes through your area through the use of a storm reserve account with Homestead Funds. Next slide, please. It just, as Martha pointed out earlier, it just seems like the story gets played out over again, year in and year out. Extreme weather and natural disasters have left their mark on our cooperatives and communities across the country. Hurricanes have torn through the Southeast, causing record flooding and wind damage. Hailstorms and tornadoes have pounded the Midwest. Extreme winter storms have hit the Great Lakes region, and wildfires and droughts have greatly affected our states out west. But the frequencies of these disasters appears to be increasing, and with that, the costs associated with them. Just to give you an idea how costly storms could be, in September of 2022, Hurricane Ian impacted Florida and the states along the East Coast. It produced damaging costs totaling $112.9 billion alone. So some of these storms can be very minor. Some of these storms can be very major, just like Hurricane Ian. And according to the National Ocean and Atmospheric Administration, we'll just call it the NOAA, 2022 saw the U.S. experience 18 separate weather and climate disasters costing at least $1 billion each in damage. So if you put those numbers in for 2022, along with 2011 and 2017 as the third highest number of billion-dollar disasters in a calendar year. Next slide, please. So this map just really gives you a visual aid of everything that Martha has discussed and I've discussed up to this point of the webinar. Our cooperatives across the country are at the risk of some type of weather or climate disaster throughout the year. And as you can see, weather and climate disasters affect all areas of the United States, and they affect them at different times of the year. So being prepared becomes important because you just don't know the next storm is going to come in your neck of the woods. Next slide, please. So a financially prepared individual has an emergency savings account to pay for unexpected costs that pop up from time to time. Maybe it's a car repair, house repair, or splurging a little bit more on a vacation that you've taken. But now we're starting to see cooperatives beginning to explore using this preparedness model to plan for unexpected and have reserve assets available in case of weather-related impacts to their territory. As I stated before, large weather events are very costly. And because of the severity of a storm can vary, it's really difficult to accurately gauge how much of the cost can be covered through insurance and FEMA, as Martha pointed out, especially when you get to that 75% mark with FEMA. Since costs of storms can vary, some cooperatives are starting to look into investment growth for reserve assets to be the solution to stay ahead of those costs. Opening and funding a storm reserve account with Homestead funds allows you to invest across our family of mutual funds, and that allows your cooperative to align investment risk tolerance and the expected time horizon at your organization's comfort level. Investing poses risk, we understand that, including risk of loss, but also provides an opportunity for a higher rate of return that can offset the cost of inflation and prices, and also the unexpected cost of a major storm in your area. So earnings compounding over time could potentially ease the cost burdens of the unexpected. And finally, just the last point, it is important to consider that cooperatives need to be sure if you want to establish a storm reserve account, does it have an effect on FEMA eligibility? Next slide, please. A storm reserve account can be a smart way to plan. For one thing, it provides a pool of capital owned directly by the cooperative to be used in emergency situations. You don't need approval of a lending agency. You don't need the approval of a regulatory agency. If you need to use assets, you become the organization that makes that decision and how those assets are dispersed. A storm reserve account can be a cushion just to help you plan for major expenditures. It can be accessible and liquid, which means that there's no waiting for FEMA aid. It could take years or a loan approval process. Through Homestead funds, withdrawals can be sent to the cooperative via standard mail check, ACH wire, which is 2 to 3 business days. We can also set up to be sent via overnight mail or overnight Fed wire in dire emergency situations. And then finally, a storm reserve account provides flexibility in case of disruptions to planned activities and expenses. So many times I hear cooperatives say, hey, yeah, we had this activity going, or we were using money for this. We had to pull it from these areas to help pay for these unexpected emergency costs from a storm. Having that flexibility prevents those disruptions to other plans and activities that your co-op has earmarked assets for. Next slide, please. So what are the steps for setting up a storm reserve account? Step one really is identifying what metrics constitutes as a major storm in your territory. Is it the number of households that are affected on your co-op lines through loss of power? Is it a certain level of cost that the event must exceed for you to consider it a major storm? So it's really identifying the proper metrics. And then step two is really researching the historical financial impact of previous storms in your area and your territory that your cooperative operates in. This will help provide an assessment of what could be an immediate financial dollar need should a storm happen right away. What is the cost of paying for overtime for employees that are working overtime on the weekends, or the cost of ordering supplies really quickly to help make the ability to fix things as they're needed in that situation? And then step 3 is really working with cooperative leadership to establish the funding and withdrawal procedures for a storm reserve account. For example, do we fund the account at a certain dollar amount if there's a storm during the previous year? If there's not a storm during the previous year, do we fund the account with a different dollar amount? Do we take withdrawals from the account if the storm causes X amount of dollars in damage? Or what if 75% of our members lose power for a period of 6 hours? Does that constitute a need to withdraw from this account? We found that cooperative leadership and the boards have worked together to determine these metrics to ensure that account assets are used correctly and for the proper situations. Step 4 is really just crossing your T's and dotting your I's, considering everything. As stated before, you want to involve your board of directors in the decision-making process for establishing a storm reserve account and maintaining it as time goes on. You should always obtain legal counsel's opinion, again, to make sure, that this doesn't affect FEMA eligibility in the future. So I think that's very important. The last thing is that Homestead Funds Advisors representatives are also available, and we're prepared to discuss this account and its operational details with your management group and board if needed. So when all the boxes are checked, then you are ready to open a Homestead Funds account in the cooperative's name to serve as a storm reserve account. And should a storm occur in the future, your cooperative prepared to make the redemptions to offset immediate expenses that occur following the next major storm. So we'd be happy to answer any questions. As Mark pointed out earlier, please feel free to put any questions in the question box and we can respond at the end of the webinar, or we'd be happy to have a follow-up meeting with your leadership group to answer some of these questions separately.
Thank you, Brian. That was a lot of information to unpack, but I think the message is clear. Being financially prepared is one of the most important things we can do. And we're here to help support your cooperative in those efforts. Next slide, please. I wanted to really, before we go to a Q&A, give the participants an update on our expanded deferred compensation tools, something that we've been working on for the better part of a year and a quarter since we took over the deferred compensation practice from INFS in January of 2022. Coming in a new website for NRECA deferred compensation plan administrators. So if you're not an administrator, but you have them in your group that have a deferred compensation plan through NRECA and Homestead Advisers, this is something that is a welcome addition to your team. It's an easy one-stop access to plan documents, participant balances, and other plan level information. No longer do you have to call and have us search or look within your files. It's a portal that's a convenient way for you to communicate directly with our consultants as well and send us questions. So we'll be reaching out with login credentials and showcasing the portal at the Interact conferences this summer. More importantly, if you don't have a deferred compensation plan, when we talked about those workforce challenges, it's an old benefit that has a lot of new features, a lot of new types of plans. Please reach out to us and talk to us about how this benefit can help attract, retain, and reward your key contributors in your cooperative. If you go to the next slide, please. So your deferred compensation consultants are Tamika and Kara. That's their number. If you have an existing plan and you want to hear more about the portal and login credentials, once that email comes out, these are the individuals to call. More importantly, if you have an existing plan and you want to get some of the features and benefits that maybe you do not have, that you should have, reach out to Tamika and Kara. And certainly if you do not have the deferred compensation plan, it's probably now more important than ever to implement one and retain those employees that are vital to the running of your cooperative. We can help with a retention program. So that's my last tidbit, deferred comp. Exciting things are happening there, and all in managing your administrative responsibilities for offering those programs. Next slide, please. So if anybody has any questions, I have Mark Edwards with me, one of our institutional consultants who is manning the lines. Mark, do we have any questions that have come in either on the market outlook, FEMA, how to set a storm reserve accounts, deferred compensation.
We have a number of questions. The first question concerns FEMA. What is the likelihood that setting up a storm reserve account could impact our co-op's FEMA eligibility?
That's a great question. One of the things that Mark Santero and I collaborated on when his group was setting up these funds was we got a really strong legal opinion from a lawyer who served as the chief counsel at FEMA in the Clinton administration and really has dedicated his law practice since then to helping cooperatives deal with FEMA. And that legal memo made it very clear that as long as the reserve fund is structured appropriately, it should not interfere at all with FEMA eligibility.
That's really important. It's something that Martha and I did work on with the support of NRECA and funding that opinion. That gives the confidence that the Storm Reserve program is not intended to bypass FEMA spending, but to complement it and bridging the costs and the reimbursements that you're not getting for that potentially 25%. So thank you, Martha. Mark, are there any other questions that might have come in?
We have a few questions concerning the Storm Reserve program. First up is, you're calling these Storm Reserve accounts, but could they be used for other purposes? For example, my co-op plans to set aside money for new vehicles. Can an account be set up and used for that purpose?
The simple answer is yes. Storm reserve is just one subset for a certain savings goal, but cooperatives can open accounts for many different reasons. So to answer that question, yes, that is very possible. We have actually had some cooperatives that have opened up an operations reserve account or an account to help building operations for a new building. So really, it's limitless for what you want to save for. And I think the most important thing is just being able to set up an account and save for whatever purpose you're looking.
Let me just clarify that real quick, because if you work with your board in setting up a storm reserve program, there are designated areas to take money from that account that are storm-related damages. So if a vehicle was damaged, or if you need new poles, or if you need to pay overtime, so a storm reserve account to get approval by your board to take membership funding to support that, there's a defined criteria. What Brian touched on, there are other types of accounts that you can establish, rainy day accounts, different types of operating reserve accounts outside of storm reserve. I think you have to be very careful what you use a storm reserve account for, so that you're in compliance with your board and set aside those monies specifically for those type of storm related expenses. I just wanted to clarify that, Brian, that you just can't use a storm reserve account to buy a new truck unless it's related to a storm related event. Anything else?
Another question regarding the Storm Reserve program. Does Homestead Funds provide investment guidance for these types of accounts?
Yes, we do. So we will work with your cooperative leadership and your board to determine what is the appropriate level of risk tolerance that meets whatever your cooperative's investment policy statement has, or just generated risk, which we can help you with through a questionnaire that can help provide an asset allocation plan. So we work with a lot of cooperatives in providing asset allocation guidance, and we're happy to do that. And it's not just the initial. We will continue to work with your leadership throughout the investment stay with Homestead Funds to make sure that your risk tolerance matches the account asset allocation mix. So the simple answer to the question is yes, we are prepared to do that. And we currently do that with a lot of our cooperatives out there.
Got one more question. How liquid is the money in the storm reserve account if the co-op needs to access it? For example, if a storm does indeed happen.
I kind of touched on my slides. It's very liquid. Again, with mutual funds, they're priced once a day. So any transaction request or redemption or withdrawal request that's placed before the close of the market day will be processed that night. And then obviously determining how to get the monies to you is something we'll work with you. If it's something that you just need a few days out, then of course we could set up a transaction to do an ACH redemption, which is 2 to 3 business days. If you need something immediately, we could work with you to overnight the funds to you via overnight mail, or we could Fed wire it to a bank account if you have it on file. So the simple answer is it's very liquid, and we'll work with you in each instance and situation to figure out what's the best course of action of getting the money to you as quickly as you need.
Thank you, Brian. If we just go to the next slide, which is just contact information. That's my number. That's my email. I'd like to close by saying I thank everyone of our presenters, Jim, Mauricio, Martha, and Brian and Mark, for answering the chat questions. Our next webinar will be in a couple of months, more information to follow, and that will be on workforce challenges, dealing with a shrinking labor force, and some of the programs that we briefly touched on today, and some of the things that we're doing with your peers in attracting, retaining, and rewarding talent, and how to combat some of the labor issues that we are all facing, not just FEMA. I thank you for your time. If you have any questions, please feel free to reach out and give us a call. Thank you, everyone, for your time. Have a wonderful afternoon.